So hi guys, it's SJ speaking, and in today's video we're going to see about price to earnings growth ratio. This is also one of the market value ratios. So it is a fundamental analysis videos. When it comes to fundamental analysis, it is useful for the investors or monthly traders. So those who are doing near time trading, for such as intraday trading or scalpers. Or short term trading, they don't need that much fundamental analysis of the company, so they can trade using the technical analysis alone. This video is for only for monthly traders and long term investors. So what is price to earnings growth ratio? So before going into the video, I'm taking trading mentorship course. So if anyone wants to learn trading from me, you can call my number from the scrolling below. For the first 25 members, I am providing a discount for my courses. So if you want my course, you can call me by that number. So coming into the video, what is price to earnings growth ratio? Price to earnings growth ratio is like an updated version of the PE ratio. So it is also known as PEG ratio. So PEG ratio is an updated version of the PE ratio. So this is one of the market valuation ratios. It is used to find whether the stock is overvalued or fair valued or undervalued. So it is used to determine the valuation of the stock while considering the growth rate of the company's earnings. So difference between PE and PEG ratio is that PE ratio only considers the EPS value, whereas PEG ratio considers the growth rate of the EPS, earnings per share. So it considers the growth rate of the company's earnings. So it can be calculated as, so this is the formula for price to earnings growth ratio, that is PEG ratio. So PE ratio divided by EPS growth rate. PEG ratio is highly reliable when used for valuing high growth companies. High growth company means the company which is currently growing at a faster pace, the company which doesn't give dividends, and it reinvests all the profit into the business for greater expansion of the company. These companies are considered as growth companies, and this ratio should not be used for the company which has already attained the maturity stage. This ratio should not be used for companies such as that. This is only used for high growth companies. Suppose if a company will have a better future, if a company would release a product which would come better in the future, so these companies are known as growth companies. Next, then coming, what we can interpret using this PEG ratio is that if the PEG ratio is more than 1, then the company stock is said to be overvalued. If the PEG ratio is less than 1, then the company stock is said to be undervalued. This is the normal assumption. But this is not always the case. When seeing the ratio for a particular stock, when analyzing a particular stock, you should not take that individual stocks ratio alone. You should compare with the other companies in the same industry, which is known as peer comparison. And seeing all the peers, sometimes every company would have more than PEG ratio more than 1. It doesn't mean that all the companies are overvalued. You should see which company has less by comparing those companies which have more than 1 value. And you can choose the company which has less PEG ratio, and you can select that company and buy that stock. So invest in that stock. So this is how you have to compare and use it. So this must be used only for the growth stocks. So example for PEG ratio. Suppose there are two companies A and B, each having a PE ratio of 20 and 25 respectively, and the earnings growth rate is 15% and 30%. What we normally assume that since the company B has a PEG ratio of 25, we will assume that company 20 is undervalued. But actually the earnings growth of A is less, but the earnings growth of B is more. So when using the formula for PEG ratio, we get PE ratio divided by earnings growth. We get the value of 1.33 for company A and 0.83 for company B. So while considering the PEG ratio, it is well known that the company B is only undervalued, whereas A is overvalued. So this is the advantage of using PEG ratio over PE ratio. So next, how to calculate the EPS growth rate? You might be assuming, I know what is PEG ratio, but how to calculate the EPS growth rate? So this is normally you don't need this formulas. This is not important because these are already calculated and shown in websites such as screener.in or investello.com or Trendline or Markets Mojo. These kind of websites has these values. But still many can learn this formula. So you can see that EPS growth rate is final EPS minus initial EPS by initial EPS into 100. This is like just normal mathematics formula. You can see. Suppose a company ABC has reported first two quarterly results for a fiscal year. A fiscal year means 4 quarters. So two quarterly results are released and the earnings per share are released. So EPS for quarter 1 is 20 rupees and quarter 2 is 24. So EPS Q3, we have to estimate the value of the third quarter. So how to estimate? So first we have to consider the growth rate. So this is the formula. So Q2's EPS minus Q1 EPS minus Q1 into 100. So 24 minus 20 by 20 into 100 is equal to, so you get finally 20 percentage. So similarly, we can estimate the third quarter's EPS based upon its past EPS growth rate, which is 20 percentage. And if we assume that the EPS growth rate for third quarter would be the same, then estimated EPS of Q3 is, you can see, since the growth rate of the first two quarter is from the quarter 1 to quarter 2, the growth rate of the EPS is 20 percentage. We are assuming that the growth rate from Q2 to Q3 to also be 20 percentage. So that's why we are taking 24 plus 20 percentage of 24. That is, of means into. So multiplication. So this is 24 plus 4.8 is equal to 28.8. So the answer for this estimate is 28.8. So this is only estimates. So these are only estimates. So analyst, financial analyst and investors such as us are only estimating the value. So this is it. Then comes the trailing and forward peg ratio. So usually trailing means past 12 months value of the earnings growth rate is taken. Whereas in the case of forward growth rate, the forward future earnings growth rate are estimated and taken for the next 12 months. For the next 12 months, it is estimated. So this is the formula. So peg ratio divided by EPS growth rate for first 12 months. So this is the formula for forward peg ratio, P ratio divided by expected future EPS growth rate for next 12 months. So you can even pause the video and see the definition. So next finally comes the limitations of the peg ratio. So every ratio has its pros and cons and peg ratio has its cons. For example, this is less appropriate for companies without high growth. So it is only reliable for high growth companies. So you have to use this ratio for analysis of high growth companies only. Next, the company's EPS growth rate is only an estimate. We are only estimating it. It may be accurate or inaccurate. It's according to it is subjective to the financial analyst. So according to his opinion, we can't say that the company would definitely grow at this rate. So this is one of the limitations. So company's growth rate is only an estimate and is subject to limitations of projected future events. So that's this video, guys. Hope you would have got a better clarification of what PEG ratio is. So how to analyze using the PEG ratio. So give a like, share and subscribe with your friends. Like and share with your friends and family and subscribe to my channel and also comment if you like the video. So I will get motivated for creating more videos. So just don't go with seeing the video. Give a like if you really like the video, and if you want to join my trading course, you can call by the number which I have given in the scrolling below. And if you want to open a Demat account, you can. I have given you Zerodha link in the video description below. You can open your Demat account and start trading from today onwards. So hope you guys enjoyed this video. I will come in another interesting videos and fundamental analysis videos such as these. So until then, bye bye, take care.